Hello, this is Nedu, your Forex coach. And in today's video, we're going to be looking at a very important aspect of Forex trading you need to pay very close attention to, all right, if you want to consistently make profits in the market. And this is called position management, all right? Guys, please pay very close attention to this. I have a lot of information to give you in this video that will enable you to prevent your account from unnecessary risk. All right, position management, and this is different from risk management in its scope and also its objective. All right, so let's hit this running. Okay, what is position management? And the objectives for this training is that at the end of this video, you would know the difference between position management and also risk management. We've done a lot on risk management, all right? And today we're going to continue with position management. And this is on that same series of how to increase your profitability in trading the Forex market, all right? Also at the end of our training today, you're going to know how to protect your entire account from risk, how to manage your trading positions, the right steps to take to improve on your profitability, what to do and what to avoid while you have some trades, okay, running, while you have some trades running. What are the things you need to avoid? All right. Okay, let's look at risk. What is risk? Risk actually is the probability that actual results will differ from the expected result. And this cuts across every aspect of life in Forex trading. So no matter how accurate that your trading strategy is or how your expectation concerning a particular trading opportunity that you have seen, you need to protect your account. All right, and in our series of profitability, we have dealt on risk management, and that is not enough. Today, we are on position management. Okay, a deeper, view and some things you need to do to further protect your entire account from risk which will arise in the market. So let's look at some definitions. Okay, what is a position? What's a position? A position in Forex trading is the amount of currencies an individual possesses in their Forex trading account, in your Forex trading account. All right. Now, when you form your Forex trading account with an amount of money, the amount is referred to as account balance or margin account balance. All right. When you open positions, a fraction of that margin account balance, not all of it, is used to buy you some currencies, okay, by your broker to buy you some currencies and to maintain the positions that are running, okay. And the value of the positions at a time, either positive or negative, is called the position balance. So let's look at some of these terminologies. So when we start dealing with the major objective of this class, you can flow very well. All right, now let's look at another thing: net asset value. Now, net asset value, okay, is the value of your assets less the liability. Okay, now in Forex trading, this value it fluctuates from time to time depending on the value of your open positions. All right, of course, you know that when you open a position, it drops into negative. If your account balance is $30,000 or maybe $5,000, when you open a position on Euro USD buy, you see that balance drops. It drops a particular amount. The position balance drops negative. Okay, it drops maybe minus, depending on the lot size you are trading. It just drops into negative. All right. So, and this fluctuates from time to time. Okay, so the net value, we said, is the total value of your assets, the $5,000, okay, less the liabilities. $5,000 less the liabilities, which would be maybe the account that is in negative. That's your net asset value. Now, account balance. The account balance here is net assets value plus the position value. Okay, so the net assets value is let's say 4,500, and your position balance is $550. So your account balance would have increased. All right, so it's just simple mathematics. The margin, what is margin? Margin is the fraction of your account balance that is required to open or maintain positions. Okay, is the minimum amount of money required to open a position or to maintain a position, and it's advised that you don't use more than 70% of your account balance, okay, in running trades to avoid triggering the margin call when the price move against you considerably. Okay, so your margin should not be more than 70%. Don't use more than 70% of your total account. And you can always see this on your trading interface, the interface of your MetaTrader 4. You can always see them running. Let me show you one. This is a demo account. Okay, let me just open a trade. I'm looking for a breakdown on the downside, okay, of this on this USD card account. Let me just get a shape, rectangle. We have seen something here, a pattern, and I'm expecting based on some fundamentals. I've been following this trade for some time now, so I'm expecting a break onto the downside. Okay, so I can take my risk to this level of previous resistance, its previous support, which might be a resistance, and of course price can get to this point. I'm just taking this trade so you can see something. If you look at their balance here, the balance on this account, which is the margin balance, $7,491 thereabouts. This is the equity. This is the position. This is the equity. All right. And now you are seeing the negative balance here. So this your position balance of -$358. All right. So if you add this -$358 to this equity, look at the balance. Balance 7491. Equity is 7488. All right. You can see it's less than this by -3.8. So that's what we're trying to give you. This is the net assets value now, the equity. This is the net assets value, 7488. So if you add this net assets value to this position account balance, which is -3, if you add both of them, you're going to get this balance, which is the margin balance. Exactly what I'm trying to explain to you on the slide. Okay, so let's go. Then the margin is the fraction of your account balance that is required to open or maintain positions, and it's advised that you don't use more than 70% of your account balance, okay, in running accounts. Okay, so it's like using 70% of the whole assets that you have in maintaining positions. We said anything more than that, if price goes against you, it might trigger a margin call. All right, and then let's look at what a margin call is. A margin call is a call from your broker demanding you to add more funds to your margin account. To add more funds to your margin account, that's your account balance, in order to maintain your open position. Some brokers may make this call when the usable margin drops, between 0 to 5%. All right, you see, when I go back to that open position. All right, so you can see the margin level in percentage. Look at the free margin here. You can see free margin 7241. You can see 7,000. This is the free margin. This is the amount of money out of this my total account balance that can be used to open more balances. You see, and you are seeing what I'm using is not up to, you see that trade is moving little profit now. It's now $3. Okay, what I'm using is not even up to how much. It's not up to 5% of my my balance, not 5%. So opening more positions, multiple positions, and multiple, you see your margin level, you can see the margin level, it will begin to drop. I still have up to 2,000 or close to 3,000%, margin level. This is the free margin, the usable margin that can be used to open more, positions. All right, I'm already using 250. You can see $250 here. This is the margin. This is what I'm using to run this particular position. $250 out of this whole money, and $250, how much the fraction is not maybe 5% of this entire account. All right, so it's still advised. So we are saying that you should not use more than 70% of your entire account balance in running positions at the same time. It is risky. It is risky. That's what we're trying to drive at, is risky. Now, what's the margin call? The margin call, okay, is a call from your broker demanding you to add more funds to your margin. When you have exhausted the margin, there is no more margin remaining to to maintain the positions or even open a new one. The broker will have to give you a call. It can be an email, it can be a direct call requesting you that you need to add more funds to your trading account if you want to still run those accounts that are in negative. Okay, so if all the accounts are in negative, price has considered moved against you, okay, and you refuse to pay heed to this call, the broker will be forced to do something. Right, be forced to start the closing of those accounts, those positions that are running. Okay, now position management has to do with the organization and management of your position to avoid this margin call. As a profitable forex trader, your goal is your goal in trading is to avoid margin call. You have to trade, manage your account properly in such a way that margin calls will not be triggered. And we say margin call will be triggered when your usable margin, your free margin, okay, drops below 5%. When it drops below 5%, you get that call. The call will be triggered. All right. Now, another thing you need to also understand is what's called the stop out process. This is actually the action of your forex broker to gradually close your own positions when a margin call has been triggered. A margin call is triggered when your usable margin, available margin, is less than 5% of your entire account. And at this time, the broker, depending on their policy, will begin to close the positions. It might decide to close the positions when it's about 5%, or leave it to run, and when it's 0, all the positions will close. Somehow they will start to close. Maybe you have 5 positions running, you may just drop 2 positions, all right, to release some margin to run these other ones. If the account continues to suffer, more pressure and risk, the broker might decide to close everything. That's the stop out, process. Okay. Okay, let's look at more definitions. At the beginning of when you are opening a trading account with the broker, okay, there is a leverage. That's a leverage that the broker gives you. That ability he gives you, to fund your account with a small amount of money, as even small as $500, enabling you, with the ability to control much more funds in the market. That's the leverage. It's leverage, and that leverage is different from this one we're talking about here. The real leverage, called the real leverage. And this real leverage is the ratio of your lot size value in dollars. The ratio of your lot size value in dollars to your trading account balance. This is different from your account leverage given by your broker, okay, to enable you to control large funds with small account balance. And this is the formula for that real leverage. Real leverage rates, okay, is open lot size multiplied by the total open lot size, if you have multiple positions open, multiplied by $100,000 divided by your account balance. All right, and a healthy real leverage rate we recommend is between 2 and 10. If your real leverage rate is less than 2, it means that that account is not fully utilized for maximum profitability. And when it is above 10, it means that you are taking excessive risk. This cannot be achieved alone if you are following risk management procedures that we have already taught in our previous video. All right. So not more than 10. Any value above 10 is taking a risk. It's putting a lot of risk on the account. All right. Then what's the purpose of position management? Please, you need to pay close attention to this. What's the purpose of position management? To protect your entire trading account from risk. And this is where it is different from risk management. Risk management actually protects a particular position. All right, you are trading to protect a position to make sure that you are not taking excessive risk on a particular position. But the position management looks at it holistically. It's about the entire trading account. Okay, and this is the whole essence of the position management, is our goal. All right, and your goal when you are trading is to maintain your real leverage rate at between 2 and 10 levels at all the times. Higher values could expose your account to margin call triggers should the market price move against you considerably. All right, now let's look at an example. Let's look at some examples. If your account balance is $20,000 and you have positions on one standard lot, okay, is it advisable to open additional position when a fresh opportunity presents itself? And see, you may not be able to answer this question just arbitrarily if you do not run some calculations which we're going to show. Okay, in this example, your real leverage rate, all right, is equal to, you are running on one standard lot, all the positions you open, maybe 5 positions on 0.2, 0.2, or maybe 1 position on one standard lot. All right, so that one standard lot times $100,000 divided by your $20,000, and you can see the value here is within that allowable and recommended limit. It means that we can actually add more positions. It also means that your account is being maximally utilized for profitability. All right. Now, the next question is, what if you were on 5 open positions totaling 3 standard lots? Then you do another calculation. Your real leverage rate is 3 times 100,000 divided by 20,000 euro account balance. So what is the value? 15. So 15 is already too high, hence you shouldn't add more positions. You see, if you add further positions, you are putting a lot of pressure on your trading accounts. Putting a lot of pressure on your trading accounts. And let's look at this. What's the account that we previously opened? We are running on a lot size of 0.5, all right, and the total balance is $7,491. I want to find out whether we can add more positions to these 1 positions that we are already running. So the calculation will be 0.5 times $100,000, okay, then divided by 7,491. The value here is 6.7. The value is 6.7, and which means that we can add more positions. The account is actually being utilized trading it 0.5. It means we can add more positions, you know, and because the allowable limit has not been exceeded. Okay. Right. So let's move on. What do you do when you have positions that are open? You've done your analysis. You have taken your trading decisions, you have executed your trades. What are you going to do to manage those positions and ensure that you trade them successfully from beginning to the end? What are you going to do? Okay, first you have to be disciplined to follow your trading plan rules. We've said this: if you do not plan your trades, you have already planned to fail. If you don't plan to trade profitably, you have already planned to have negative results. So you must have some trading rules, and particularly in this area now, we're looking at the trading rule as it pertains to your risk-reward ratios. This is where a lot of traders miss it, particularly newbies. A lot of traders miss it. Your risk-reward ratio, 1:2 is fine. 1:1.5, 1:1.3, whatever works for you, that you have outlined as your trading rule, the guidance. You have to maintain it. Be disciplined. The reason we'll tell you to backtest your trades. You have to backtest your strategy, backtest every aspect of your trading plan, all right? And it becomes a part of you. It becomes, what you breed. That's what you think. It has become a culture, a trading culture for you. All right, so be patient to allow that price to hit your take profit target, except until trading conditions have changed. All right, don't be in the habit of, closing your trades when your price profit targets have not been hit. That is not allowed. Again, when your positions are running, you have to be connected to information feeds from some Forex channels to monitor any change in fundamentals that have the capacity of affecting your trading positions negatively. You have to, be open to informations. Can be on some TV channels, Bloomberg, a lot of them, some economic websites that you can read. Okay, and then also news feeds coming from your MetaTrader 4. You can see some economic data that are released. That's where your attention should be, and not on being glued to your screen. Avoid fixing your gaze on your screen to monitor price. Of course, looking at the price actions there, I will tell you what it will do and what it will not help you do. See, you're looking at the price fluctuate, move up and down, will not determine the direction of the price. Price will definitely move. You can't hypnotize price. You can't charm it. Price will move in the direction. That's why you really have to be thorough in your analysis. You have to be thorough in interpreting all your data available to you before you can take a trade. Once you have taken that decision, you are in already. Okay, you are in already. So don't glue your eyes on the screen to monitor when price moves up or down. It will not help you. Rather, it will trigger some emotions in you. All right. If your take profit value maybe is 150 pips or less, or maybe 50 pips or 60 pips. Okay. When you see price move up and down, because that's the price behavior, it moves up, down, it moves like in waves. It will rise, it will fall, it will rise, it will fall. If you see that, maybe when you see the market, gone about 20 pips, 40 pips in your favor and returns back to 30, you may be emotionally destabilized, and then you can take a very rash decision of closing that position that eventually would have moved you, to your profit target. What do we advise here? We advise that you don't get induced, by these emotions, and then by the fear of losing out on so much money if you allow the trade to whatever you have already accrued in your account to lose out. Of course, maybe your previous position, you saw that the price moved close to your profit target of 60 pips, maybe got 50 pips, and from there it fell and returned and took you out on stop loss. All right, and because of that, you're now trying to change your plan and change your behaviors, change your attitude towards trading. Any amount you see, just close out. It won't help you. It has never helped anyone. So you need to take this decision. Another thing is allow the market to move. Once price has moved maybe 2.5 times, maybe about 50% of your profit target. 50% of your profit target, then you can begin to trail the market using dynamic stop loss. Okay, once you have like 50 pips, depending on your profit target, or 60 pips, you can move to break-even level, so that if the market price returns and takes you out, you're already running on zero risk on that account. So if it moves further, you can lock in more profits, lock in maybe about 40 pips, come what may, the price returns back and hit your stop loss, you have something already secured in your account. All right, I believe that this video has given you more direction as to the objective of becoming profitable in your trading. If you benefited from this video, if you feel that the video makes sense, please, would like you to hit that like button, share with your friends, and then subscribe to our channel so that you can, and also click on that alert button so that you'll be alerted when we have a new video. Thank you so much for watching this video and visiting our channel today. I will see you again in the next video.